Welcome, everybody. My name is Jeff Fowler with the Apartment Owners Association. And as always, it is great to have you with us today. And today we're going to talk about the intelligent 1031 investor. And so that's a 1031 exchange into a DST. So for some of you, that is the smart choice. And for others of you that want to remain controlling everything, then it's not the right choice. And there's definitely something to be said about both of those positions. So, but before we get into that, AOA has been around for over 40 years. Many of you have been with us for a decade or longer, and just so thankful for you. So again, it's good to see you here. And we hope to see you at the Long Beach Convention Center for the $1 Million Trade Show, sponsored by AOA, and it's also actually sponsored by this, I believe it's sponsored, yes, it is sponsored by Petra Capital, and we're going to be hearing from them today. Yeah, and before we get into that, AOA, again, it's been around for over 40 years, and our goal is to help you increase your revenue with your property and to increase the ease of doing it, the happiness level. And man, there's so many different rules and things and regulations and changes that are making this more and more difficult every day. So you may have missed it, but we had How Much Can I Raise the Rent in LA just yesterday. We had essential security deposit information, a live stream about that. And these things are on YouTube. If you're watching on the AOAUSA.com website, we have a YouTube channel. It's called AOA USA. And if you look at that channel, you'll see that we have all kinds of content there. And so highly suggest that you subscribe and then hit the notification bell for that so that you get all that information. And then we had one on rent control in Buena Park, and there's specific tenant protections that you need to know about in Buena Park. And one that is coming up, will be next week, and it will be rent control in Inglewood. And that's the last live stream that we're going to have before we have the $1 Million Trade Show. And it looks like we're going to have over 150 vendors. And we're not talking booths, we're talking vendors. There's going to be over 150 different contractors and just different companies that are going to be there that cater to people with investment property. And of course, over 20 different seminars that are going to be going on as well. So we want you to attend that and get all of the information that you can out of it. It is a power-packed day, so much information, and so hopefully you'll be able to make that. Definitely I will, Lord willing. And let's see, what else can I tell you? Oh yeah, if you are watching on the AOAUSA.com website, there is a blue help button, and you can use that to type in your questions, and then they can funnel those questions to me. So if you have a question, you can put that in the chat, and they'll get that to us. All right, so here we go. Our sponsor today is Petra Capital Properties, and they're independent and national, combined total of over 100 years of experience. They have offices throughout the country, and over $10 billion in property value that they've exchanged. And their investment mandate is preserve capital and protect income. Preserve and protect, and I think that's well put, and I think, that's definitely the filter that they're filtering everything that they do through. And they have a proprietary data technology model, and I think you'll see a little bit of that today, and you'll hear from a few different people. So this is going to be great, but first of all, we're going to kick it off with the founder and managing partner of Petra Capital Properties, and he has over 35 years of experience, and so it's real estate investing experience. So it's really my pleasure to introduce to you today Brad Watt.
For allowing us to participate in the Apartment Owners Association of California. It is an opportunity we look forward to every month and have been for several months now to really just try to help educate and provide information and what we consider to be really relevant advisory services, real estate investment advisory services to investors who are seeking to reposition or transition their holdings, their current real estate holdings, from active property management to passive portfolio income. And we have a very simple but elegant solution to be able to do that. And we're going to talk about that today and kind of how we're different, what we do, how we do it, and maybe more importantly, why investors should be interested in some of the solutions that we're going to talk about today. So thank you all for joining. I'm also joined today by one of our managing directors, Michael Chabot, who's on the screen here, as you can see. And then I've also got Luke Lofman, our president and chief investment officer. And we wanted to maybe just turn this into a little bit more of a podcast format, more of a dialogue with some Q&A between Michael, Luke, and I, to really highlight some of the top questions that 1031 investors are asking today, some of the challenges they're facing, and what are some of the opportunities that they have available to them in this very challenging market with higher interest rates, higher inflation, rent controls, eviction moratoriums, additional state and local taxes for short-term rentals and Airbnbs. I mean, there's a whole host of challenges facing landlords today, particularly in California. And we think it's important that our investors understand that we're aware of those challenges, and we understand the threats facing landlords today. And there's some opportunities maybe to, as they say in, I think the Chinese character for opportunity and threat is the same thing. So what is a possible threat or a challenge can equally be an opportunity. And that's what we want to talk about today, with some ability to transition real estate holdings. So with Michael and Luke on the line, I'm going to go ahead and just make a few opening comments, and then we'll turn it into our Q&A. Really, if you want to just take a look at the screen here quickly, I'll just run through some quick slides to set the stage for some of our questions that we're going to, Michael and I and Luke are going to discuss today. Again, the goal here is to try to make all of you on this call a more intelligent 1031 investor for those of you contemplating selling and transforming or transitioning your current property to a much higher quality, potentially higher income replacement property. And again, doing that in an environment that is presenting some challenges today, but again, we're hopefully going to provide opportunities for you guys to potentially upgrade some of the holdings that you might have. So here's a little bit about who we are. Petra Capital Properties, we are independent real estate investment advisory company specializing in 1031 exchange solutions. We do have a national platform. We have offices in several states, as Jeff indicated. We have 100 years of combined real estate investment and advisory experience in both public and private real estate offerings. We have a very proprietary program or platform called a personal optimized property portfolio, which Luke will showcase for everyone on the call today. Essentially, what this allows us to do is give investors the opportunity to access our proprietary research database on our 1031 exchange properties that we have available, and then customize and personalize a portfolio that matches their exact risk tolerance, yield requirements, and investment objectives. So it's very much an interactive, collaborative process that we go through with our investors to make sure that we've customized a solution that matches exactly what they're looking for their long-term income and estate planning goals. It's very unique, it's very different, and our investors love the experience because it allows them to have active participation in their portfolio construction with all the benefits that come from passive income with multiple property ownership. So you'll see how that comes together here in a little bit. We do have access to about 45 different Delaware statutory trust sponsors. We don't do business with all of them because we don't think all DST sponsors are created equal, just like all real estate's not created equal. But we do have a very strong vetting process and a rigorous underwriting analysis that we go through for each property and each sponsor in our platform to make sure that they've met all of our stress tested criteria. and demonstrate what we call the 3 Qs. And that's the quality of the assets, the quality of the income, and the quality of the sponsor. Every single program that you're going to see represented by Petra will have gone through a stress testing model involving those 3 Qs: the quality of the assets, the quality of the income, and the quality of the sponsor. We can't guarantee outcomes. Nobody can, but we certainly can anticipate risk. And that's what we're really trained to do as Petra advisors, is we're risk managers. And our goal, as Jeff said, is to help you do 2 things: preserve your capital and protect your income. You worked a lifetime to create wealth. You now want to preserve it and hopefully enhance it. And that's what we specialize in doing for our investors. Quick review of 1031 exchanges. Again, many of you on this call are here because you've either done an exchange or contemplating doing one. As you know, you've got a very limited window to identify property in a 1031 exchange. Any property that qualifies that's held for investment purposes or used in an active trade or business is qualified to be a 1031 exchange or to receive 1031 exchange treatment. The hard part in this environment, particularly with inventories being tight, interest rates and qualification for loans being much, much more stringent than they have been, it's really starting to affect the process of identifying properties in this environment. So that's why we think investors need to be particularly attuned and careful to make sure that they know what they're going to buy before they sell. It's very important because that 45-day identification window moves quickly. As many of you know, in addition to your 45-day identification period, there's a 180-day closing period. Generally not a problem when you're identifying existing cash flowing properties that can be turnkeyed within days after your closing. And that's one of the major benefits of the Delaware Statutory Trust. 1031 transaction requires a QI. Many of you know that's essentially an escrow agent or a custodian that holds the proceeds. You've got 145 days to ID, 180 to close, and you generally have a 3-property rule for identification without regard to value. You can identify more than 3 using what's called the 200% rule. That's particularly important in a Delaware statutory trust as we build more of a mutual fund approach to real estate ownership, where we're going to have multiple properties with multiple sectors, multiple geographies, and that allows us to really build a much greater diversified portfolio that helps protect the investors against both deflationary risk as well as inflationary risk. So by definition, our portfolio construction is going to require a lot of diversification, which is what we recommend. As a result, we're going to be using the 200% rule, which means you can identify up to 2 times your exchange value. So what's the investor dilemma today? Serious problems out there, as we know. We're, as one economist said, we're living in the axis of upheaval, where social, political, and economic unrest all collide at the same time. So investors are facing a lot of financial and economic challenges today, and not the least of those for 1031 exchange investor is the taxes. Combined in California, as you know, they can approach as much as 45 to 50%, depending on some of the state and municipal, or some of the municipal and local taxes. Don't forget you have recapture, you also have Medicare tax, and of course your federal capital gains tax rate is 20%. When you add up all those taxes on a blended basis, it can easily approach 45 to 50% in California. With a low basis and a high capital appreciation, your tax liability for many investors is going to be in the 6 figures. In some cases, we see it up in the 7 figures. It's a lot of money to forfeit for the future earning power. With the age of most of these investors living another 20 years, you do not want to write that check for taxes. The compounded effect of that wealth will, it's enormous if you give that up. So we know taxes is a problem. Time is a problem. 45 days, we talked about it. Not enough time to truly find, locate, underwrite, due diligence, get a financing commitment letter. Just not enough time to get everything you need to do to find a directly owned and managed property. That's why the turnkey Delaware Statutory Trust solution is an elegant and simple way to eliminate this time constraint. And then the access, again, tough to find properties in today's market that meet most investors' criteria for stability, income, and growth. They want all three. It's tough to find those properties that fit all that criteria in that 45-day time frame. So here's the problem. The owner owns a property that's tired. They're tired. They've had it for years. They've depreciated it down to a very low basis. They've got enormous capital gains embedded in the property. The property's typically unperforming. It's undiversified. They're limited to single property ownership. There's deferred maintenance. There's hands-on management. They don't want to be a landlord anymore. They've got irregular income. They've got tenants moving in and out. They've got cessations of income. So there's not a predictable income stream. And there's extraordinarily, as I said earlier, a low tax basis. So this is the classic setup for a single owner operator investor who is in today's market. By doing a 1031 exchange using the Delaware Statutory Trust, or DST for short, we like to say that investors have portable income that can now be used for a living, giving, or legacy. Many of our investors are philanthropy-based or charitably minded, and they want to give away some of their income. But the problem is they don't have the certainty of income and the predictability of income, nor in some cases even the amount of the income that they want to use for some of their charitable contributions. So we love the idea that the way investors can convert from single property ownership to multi-property portfolio ownership with passive income, it really enhances their ability to increase their living lifestyle, potentially give away more money, and at least for their kids' sake, clean up some of their holdings so their kids are inheriting a portfolio of much higher quality real estate securities as opposed to direct property ownership and management. So a lot of the next generation would prefer mom and dad to do this conversion to a portfolio of real estate securities. So that's the idea, the DST solution on the right-hand side. Now you get new properties, you get cross-asset diversification. Maintenance reserves are already built into the properties, so you'll never get a capital call. You've got third-party professional management. You've got projected monthly cash flow that's more programmatic. It's more predictable. It's never guaranteed, but it's more programmatic and predictable than single property ownership. And you get tax efficiency to go with it because you've got additional write-offs potentially for interest expense and depreciation. So we can increase your after-tax income potentially with the DST model. So that's the classic setup. Michael, I'm going to turn it over to you for a few minutes and walk us through some of the questions or challenges facing 1031 investors today.
All right. Well, thank you, Brad, and welcome everybody. As Brad mentioned at the top, I'm one of the managing directors here at Petra. I built a career in real estate in California for most of my life, so I'm very familiar with the challenges in the California real estate market. And Brad, that was one of the questions that we initially talked about, which is some of the tightening regulations and the things that are happening in California, such as the insurance crisis, rising interest rates. There's a new short-term rental tax coming out that may or may not affect people on this call. But just a lot of things happening in California that are very specific to that state where people are owning. So, Brad, if you wouldn't mind, just expand a little bit on those few items that we just discussed.
Yeah, some of the basic things that we're aware of that most of our listeners on this call are very well aware of as landlords. We've got short-term rental regulations. There's now a 15% tax that begins in the next year and a half that's going to affect short-term rentals. So we see that there's a lot more regulations, restrictions, and taxes now that are starting to affect the Airbnb business or short-term rentals. We also know that we've got a tremendous pressure on insurance costs. We've got many insurance companies that have canceled or pulled out of Florida, California, other coastal states. Folks cannot find insurance, and if they do, they're paying more, in some cases twice to three times the insurance premiums they were previously paying before a lot of this disaster has been hitting our country over the last few years with hurricanes and storms and fires. So people are having a harder time managing their operating costs with rising premiums and property taxes, insurance premiums and property taxes. So NOIs are being squeezed, net operating income. At the same time, interest rates are going up. The combination of those two is putting a lot of downward pressure on value. And that's why we think today is a good time for investors to be sellers and not holders, because it's only going to get more challenging with more headwinds going forward as the city, states, and federal government continues to be aggressive about raising more taxes to cover this $2 trillion deficit that we're running in this country right now. So it's a good time to consider being a seller and transitioning your lifestyle, if you will, from direct property ownership to passive portfolio income.
Well, that's a perfect transition, Brad, because we talk about all the time how landlords have a hold, sell, buy decision to make. Expand for people here today on a property sale versus a portfolio buy and the average return versus typical yield on a Petra portfolio design.
Yeah, it's based on the last report I saw from Urban Land Institute, ULI, the average landlord that owns a residential rental property, whether it be single family or multifamily, the average return is less than 2.5% on the actual investment value when you take into account capital expenditures, insurance, taxes, all of the operating costs of the property. And again, CapEx is a big one, capital expenditures. You got to deduct that from the overall cash flow. And then you've got your cost of capital, your interest expense, and your principal amortization. So when you blend it all together, you're talking about 2.5% return. Our portfolios, by comparison, generally speaking, when we build a new portfolio for a client, we're able to push it closer to a 5% starting return, cash on cash. So that's generally where we're at today, and that's blended over multiple asset classes, multiple geographies, and multiple managers. So again, no guarantees, but we're able to build a portfolio today to a starting cash return of 5% annualized.
All right, so I know we're running short on time already, and I want to give Luke enough time to show his magic. But let's combine the last two questions into one, which is, what does the typical 1031 investor look like for Petra? And more importantly, what does the transformation from active ownership to passive ownership look like?
Yeah, our typical investor presents with older, generally in their 60s. The properties they've owned are anywhere from 17 to 21 years old. Again, low returns, a lot of deferred maintenance. They're looking to transition into a much higher quality real estate ownership with greater diversification and potentially higher income. And again, remember, the income is just a part of the equation. We hope that we can increase value through capital appreciation as well. So investors in a DST benefit both from current income and potential capital appreciation. So all the direct benefits of ownership that you have of direct properties transfers over to a DST portfolio. Current income plus potential capital appreciation. As far as the investors are concerned, why they should consider this today, again, I think it's just a lot of it comes down to, do you want to continue to be a landlord at this stage of life, or would you rather transition from return on investment to return on life? We call it ROI to ROL. And that's where a lot of our investors are at. They want to improve and increase their lifestyle. They want to have freedom. They don't want the burden of day-to-day property management, but they absolutely do not want to pay those taxes. So the best of all worlds, defer your taxes, get away from day-to-day property management, and own a portfolio of higher quality income producing properties that are managed by some of the best real estate investment companies in the country. That's the trade-off for most investors today, and that's what we can offer. That's it. Yeah, Luke, do you want to walk us through a quick portfolio, Luke, and take us through how we build it in 1 minute or less, because I know we're going to open it up to Q&A, how we get to a diversified portfolio.
So as Brad mentioned, we have a system that we use, proprietary system. It's called a POP, or Personal Optimized Property Portfolio. And we utilize that system in order to create a strategy and different scenarios for investors that we work with. And in this example, I won't run through all the details, but this is fairly recent. A client was selling a property, about $3.9 million was the sale price. They had debt to replace on that sale. So as everyone knows, when you go through an exchange, you have to replace the equity that you receive and the debt as well as part of that exchange. Otherwise, you're going to pay mortgage boot on the debt that you don't replace. So in this particular example, the investor had to replace $800,000 of debt. However, they didn't want to assume too many properties that had debt on them. They wanted to buy properties that were all cash and offload a lot of that debt replacement risk to almost a single asset. So we had built a handful of different portfolios. This particular portfolio included a government leased property, a portfolio of Dollar General properties, some healthcare related assets that are single tenant net lease deals, a asset in Florida which is under the multifamily structure. It's assisted, or it's manufactured housing. We also had some land, developable land, that we incorporated into their portfolio, and some natural gas. So this is mineral rights, which is eligible for a 1031 exchange as well. So a very diversified portfolio. And then topping that off, we included 3 Amazon properties that are sortation and distribution facilities, and that served as a utilization for them to replace their debt. With that particular exchange, they ended up acquiring in total 7 different acquisitions. So they were in the 200% rule in this particular case. And those 7 different acquisitions consisted of 32 different properties and a little over $10 million square feet of property in the United States. Just to get an idea in terms of projected cash flow over the first 5 years, their cash on cash yield was equating to just a little bit over 5%. So for their particular investment, their expectations were $145,000 annual for the first year of income received, and then that it grows over time. And on top of that, all this well-diversified portfolio replaced their debt, in a majority of it, in one particular deal. They allocated only $90,000 to replace $551,000 of debt, which is all non-recourse to them as an investor. And they were able to acquire a significant number of assets in all cash, a few of which had small amounts of debt attributed into the capital stack. So that's kind of a foundation. We go through this process with every investor that we work with. We build out custom portfolios in different scenarios, and we can showcase it in this particular format.
Thanks, Luke.
You're welcome.
So basically multi-property ownership, much higher quality, passive income, and most importantly for you investors that have debt, non-recourse in the Delaware Statutory Trust. I cannot overemphasize at this stage of life, for most of us, we do not want to be signing personal recourse for debt in this environment, particularly at much higher interest rates, which creates more stress on the asset down the road when you go to sell it to the next buyer. So signing recourse is not advised in this environment, and that's where the DST can also help offset some of that risk or reduce that risk of ownership, because there is no recourse debt. There is no personal recourse required for the debt, but you can have all the benefits of the debt without the recourse. So we'll leave it there. Jeff, turn it back to you. Thank you.
There we
You're
go.
muted.
Thank
There
you,
we go.
guys. Great presentation. And now is the time to ask questions. So go ahead and put those in the chat. And again, if you're on AOAUSA.com, if you're on that website, there's that blue help button. Click on that. You can get a question in there, and they will funnel that over to me, and we can take your questions. And so here we go. Just to start off, we have on YouTube, we have David, and let's take a look at his question here. Okay. I've heard that if you want to sell your DST interest, you can't get a fair price and have to sell at a big discount. If you own a triple net property that you control, you can sell at a fair price. So give your thoughts on his comments there.
Well, first of all, I've been buying triple net lease properties for 4 decades, and they do provide the income and the flexibility as direct ownership for sure if you want to sell it. The problem is they're very vulnerable to interest rate increases. So just because you can sell it doesn't mean you're going to get the best execution or price. As we've seen now, cap rates are starting to trend back up for triple net lease, which can affect the value. That's why we do not like or suggest single property ownership for anyone. We absolutely believe now is the time to diversify for safety, for quality, and for income. All that said, the question is, how do you get out of a DST? The DSTs do have some features built into them, some of them where you can redeem your shares back to the sponsor for cash. You can actually get out before a traditional sell period of 5 years. Some of the sponsors, like oil and gas, for example, the mineral rights, which is royalty income that the investors receive, and it's 1031 qualified. Actually owning mineral rights is qualified for 1031 exchange. We have opportunities to invest in those mineral rights, mostly natural gas. That particular sponsor allows for the investor to redeem their shares 30 days after they've invested in the program. We don't recommend it. It's too soon. You got to be careful to not violate 1031 held for investment purposes rules, but you do have some DSTs that have some liquidity features built into them that allow the investors to get out sooner.
All right. And every any kind of investment carries risks, and some of those risks are similar, some of those are different for sure. On YouTube, we have Ken. How liquid are DSTs in the secondary market? Are there commissions and secondary market discounts associated with DSTs sold? So similar, slightly different questions there.
There's not an active secondary market. It's more of an informal auction market that goes on for DSTs. There's a handful of sites that you can sell your DST interest. We don't recommend it. In the past, when interest rates were low, some of these DSTs were selling at premiums to their original par value. As interest rates go up and that DST income becomes less, comparatively speaking, they may trade at a discount. So it's just like a bond. It's going to trade at a premium or a discount depending on where current interest rates are. So DSTs, generally speaking, should be planned by the investor to be held for 5 years, give or take. There are some earlier exit strategies built into certain DSTs, as we discussed. I do not recommend the secondary market. We also have lenders that will lend against DST equity. It's real estate, and you could own a portfolio of DSTs and use that as collateral for the lender to make a loan. So if you need to get liquid, there are other ways to do it other than accessing the secondary market.
Now, you mentioned the interest rate, and I think we're kind of coming up in the next couple of years here. There's going to be some interest rate hikes that are going to be felt by commercial property real estate. And we already see some trembling, some shaking there. You see some certain companies walking away from things. Can you speak to that? What you're seeing in the market?
Yeah, the two most imperiled asset classes, if you look at the debt that's got to be rolled over in the next 18 months, commercial real estate debt, CRE debt as it's called, it's about $2 trillion coming due. It's hitting a maturity wall, as they say. And that debt largely is held by about 60% is held by regional banks and national banks. And that is a concern because if you look at the asset class populating or denominating most of that debt, it's multi-tenant office and multi-tenant retail. Those are the two most imperiled asset classes today, multi-tenant office and multi-tenant retail. We absolutely are not recommending exposure to those two asset classes under any circumstances to our investors. We are not even touching those with a 100-foot pole, let alone a 10-foot pole. So that's where we are on those two asset classes. Yes, interest rates going up will affect the valuation of these properties, but those properties that were already in trouble before interest rates rose, which multi-tenant we know has never come back post-COVID, those asset classes are going to be more impacted by higher interest rates. So we see the biggest drawdown in risk or value rather being in those two asset classes. We certainly don't like the idea that rates are going up and how that's going to affect general real estate pricing. But that said, that's why you want to be into these DSTs potentially, which have lower interest rates because of the size of the borrowers. These sponsors are huge, and they're borrowing money at rates that investors cannot touch in today's market. So we are able to get a lower interest rate with non-recourse debt that somewhat insulates investors today from going out to the general market to borrow money. But no doubt about it, higher interest rates are here to stay, higher for longer, in our opinion.
Great. Why don't you tell me a little bit about that? I have my opinions. There's things that I'm reading, but I sounds like we're on the same page. Where do you see interest rates going over the next 5 to 10 years, and what do you see happening there? Just curious, because it really impacts the price of real estate.
I think we're in a catch-22 where we're going to have price inflation for a while. Interest rate inflation, I think, is going to ultimately happen until the economy crashes. So I do think we're going to be headed for an inflation-induced recession. When that happens, I think the Fed is going to be forced to pivot. The problem is much of the damage will have already been done by then, and much of the value will have already been destroyed. And so it's going to be a rebuilding process when the Fed does finally pivot and reduce rates. But I don't think price inflation goes away anytime soon, particularly with oil being restricted now by Saudi Arabia, by Russia. We've got constraints all over the country, all over the world, that's going to increase oil prices. We're seeing $100 a barrel now, pushing 100. So I think price inflation, food inflation stays in the market for a long time. I do think asset deflation will take over pretty quickly. It's already starting to happen. And as rates go down, I think the Fed's going to try to pump life back into the economy. And that's where investors, if you're holding cash, if you've got some liquidity, it's going to be hopefully some opportunities to make good buys. So I do think we're going to be higher for longer, but I do think the Fed will pivot probably sometime late next year when the economy tips into a recession.
All right.
That's my opinion.
There we go. All right, Ken on YouTube. Are K1s or 1099s issued on DSTs?
There's an actual grantor letter. It's called a statement of revenue and expenses that's provided by the sponsors at the end of the year. It's a grantor letter for the Delaware Statutory Trust to the investors. That's what it's termed or called. That letter, that grantor letter is again just a statement of revenue and expenses with a capital allocation between the land, the building, and what's qualified as real property under a cost segregation model. So the components of the investment are outlined on this letter along with the revenues and expenses. That all rolls up to the Schedule E of the individual's tax return. So typically an accountant will get that CPA. They will prepare the investor's tax returns based off of that grantor letter. It's very simple statement reporting, but it's all there. It's very clear, and it behaves a little bit like a 1099, but it's not.
And I know that you guys, when you put that together, it's showing they're going to have to pay taxes maybe in different states on revenue.
Correct. Some of these investors, because they're in tax-free states, we try to allocate them to tax-free states, so there is no state tax requirements. Those that do have it, again, we're going to make sure the real estate fundamentals trump everything else more than just the potential taxes do.
That's right.
Because we're very real estate focused. It's all about 1031's an investment strategy first and a tax strategy second. Don't get those out of order. That's our philosophy.
And don't ever get. Yeah, that's right. I'm sorry. Go ahead.
That said, there are consolidated reporting for multiple states. Some CPAs will file essentially, or they will effectively not file taxes in the states because there's a de minimis requirement that if you don't reach a certain level of income, you don't need to file. You don't owe any taxes. So they'll just say, don't file the tax return if you don't owe the taxes. So effectively, we're reducing the income in any given state because of the diversification across our platform. So individual states are not as big of a reporting issue for most of our investors.
Great. Well, we're going to wrap up here pretty soon. Guys, if you have any other questions, definitely put them in the chat. And I liked what Luke put together there, and it showed us what the cash flow would look like. It was a little bit over 5%. And I know past performance does not indicate the future future return on investment there. What do you think we're looking at with these mortgage rates? They will increase. Is that going to impact the bottom line on rate of return here, cash flow?
Luke, you want to discuss that?
Well, some of the acquisitions that we've seen as of lately, yes, they're financing the properties at a little higher rate than they were a year ago. But in the same cases, they're acquiring the property with better terms. Either it's a better purchase price or the NOI has increased substantially over the last year. So even properties that our investors got into a year ago, some of the rates on the financing were around the 3.5% mark. So phenomenal locked in 10-year fixed interest rate. They paid a little bit more for it back then, but over that year period since then to now, the NOI has grown quite substantially. Top line revenues have grown. Some expenses have grown, but NOI has overall increased. So the property value has increased over the last year. And now they're in that low interest rate financing. they're in a good position. And same with new investors currently, they're getting a little bit better pricing on acquisitions, a little higher interest rate, however.
And then here we got another intelligent investor that's asking a question, Daniel on YouTube, and he asked, does your 5%, around 5% return, what does it include, and what is owed on taxes for that 5%?
So that 5% yield that was mentioned, that's a cash on cash yield. So effectively, that's whatever the equity investment was. Say it's $1 million, well, $50,000 ish would be the distribution. There's no additional expenses taken out of that. However, you would have to pay taxes on a similar amount to that $50,000. What actually happens? Your cash flow is going to differ a little bit than your income, your taxable income that you receive, because you'll have interest deductions, depreciation, and some of these properties do cost segregations, which further improve your taxable cash flow. So in that case, you may only owe taxes on roughly 50-60% of the income that you actually receive.
Got it. All right. And then Barbara, can we get copies of Luke's presentation documents to evaluate the numbers?
Sure.
Absolutely. Yeah.
So you see the phone number, you see the email and all that information at the bottom. You could pause the video and blow that up if you can't see it, and give them a call, shoot them an email, whatever. And Barbara, they'll be able to get that to you. And anyway, guys, again, thank you so much. I really appreciate the expertise, just the experience that you guys have, that you bring to the table, meeting all three of you together like this. I think it's apparent for other people that are watching as well. And so thanks again. And everybody that's watching, thank you. And definitely don't be afraid to give them a call. And that's it.
Can I just make one more comment? We will do a free consultation for any investor on this call. We will design that portfolio that Luke just described. We'll bring the investor into the portal and we'll access all of the DSTs. And then he will literally put together multiple combinations of different portfolios that match that client's exact personal preferences, their risk tolerance and their yield requirements and their overall estate planning and liquidity needs. And we will do that for them with a free session. So just want to throw that out for all the AOM members. I think it'll be invaluable for you to see what you can trade from and into, and knowing that you're doing that, hopefully getting that return on life that you're looking for at this stage of life,
right,
with the portfolio.
Right, and doing your due diligence and getting something like that is what intelligent investors do, right?
Amen. All right. Couldn't have said it better myself. Way to close this out.
And then one other thing. Are you guys going to be at the trade show in Long Beach?
We are.
Okay. You got a booth?
We do. Front and center. I think we got some prime real estate. As real estate people, we should, right?
And are you guys are you going to be speaking?
I don't believe we've got a speaking slot. I think we got a little late into for that.
Okay.
Unless you can figure out a way to shoehorn us in somewhere, Jeff.
Yeah. Hopefully no one will have a bad accident or something.
Right. Well, thank you. We do appreciate you a lot and your service for AOA and all that you do. And thanks for making us part of the family.
You got it. And enjoy that Colorado weather.
We will. It's getting cold. I think 29 degrees on Friday. So fall is in the air.
Okay. Hey, take care, guys.
Thanks. Thank you. Thanks, guys.
Take care. Thank you.
Thanks. Bye-bye.